This is Barry Knapp with Ironsides Macroeconomics. It's Sunday evening, March 20th. Our note this week, released on the 19th, was titled The Road to Redemption. It's a reference to the Fed taking a couple of steps towards regaining credibility last week. It was a good week for the Fed. So there's four sections to the note. The first one was on regaining credibility, and we dug in pretty good around what happened last week with respect to the Fed. The second section of the note was when we got a little deeper into the Fed forecasts, the balance sheet plan, and what the implications are for the broader economy, the Fed's reaction function for the rates market. We pushed back pretty hard on a lot of the talk we heard about the Fed driving us into recession because the 2s, 10s Treasury curve flattened and 5s bonds Treasury curve flattened. We think that those arguments are really misguided, I guess would be the best way to put it nicely. The third section of the note was Chinese Central Committee credibility, and we do not think the speech from the vice chair last week helped our outlook in China at all. Short term obviously caused a pretty sharp snapback, but we still are as bearish on China as we've been. And then the fourth section of the note was what we titled The New Map. That was a reference to Dan Yergin's excellent book, The New Map, about the reordering of energy markets and how we did get some clearing of the crude market early last week as Russian crude reached China and India, and the market cleared temporarily, but longer term, we think that the outlook for U.S. energy companies in particular is quite strong, and there is going to need to be a major restructuring of global energy markets over time. So moving on to the Fed, as we said, we thought it was a really good week for Fed credibility. The first piece perhaps is a little bit cynical on our part, but it was the collapse of the Sarah Bloom Raskin nomination for the Fed, and the Fed subsequently not getting into the ESG business. That would have been a highly political outcome for the Fed and would be very bad news for their credibility over time, which has obviously struggled quite a bit recently. The second really good note for the Fed is, and we'll talk a little bit about their forecasts, which do seem somewhat incongruous, but the important piece about the rate part of the forecast for us last week was the Fed's acknowledgement that they are going to have to take the policy rate above their estimate of the neutral rate, right? It was an acknowledgement that they will actually have to have tight policy to get inflation under control. It's not a complete admission of their contribution to the inflation blowout that we're underscoring, but they are acknowledging that someone's going to have to fix it, and it's going to have to be them. They are going to have tight policy. It doesn't look like they think it's going to need to be all that tight, but we'll burn that bridge when we come to it. And then the third piece was what we wrote about a couple of weeks back, where we described the battle of the balance sheet and how Midwestern hawks wanted to get started with balance sheet contraction right away. And a number of the coastal doves really wanted to wait till they got 100, 150 basis points of rate hikes done before they started balance sheet contraction. Powell all but committed to starting balance sheet contraction in May. So those two monetary policy steps to us were big, and it contributed to the rally last week. Now, clearly we had written and believed that the market was very well priced for the Fed outcome, even a more hawkish outcome than we expected. And that's what last week was. Make no mistake, they were more hawkish than expectations, than market pricing. There was another rate hike in there relative to the Fed funds curve. The survey that we participated in with CNBC, balance sheet contraction is coming sooner. Rate hikes are more significant. So this was hawkish, yet the market rallied S&P rallied 6% last week. And that's because the Fed took those steps towards regaining credibility in our view. Furthermore, we also had a pretty good week for our view that there's no stagflation in the offing, right? The stagflationism had a bad week. First, when you go through the February data that we got, so somewhat pre-invasion, retail sales were really strong on a 2-year stack basis. They're running 11.6% annualized. So retail sales are still quite strong. We've been arguing that Joe Sixpack could take it. He had plenty of firepower to deal with the price hikes, and the retail sales numbers surely show that. Industrial production is running 7.5% above a year ago, and housing starts are running at a really robust level, led by single family starts and single family permits. So the economy had a lot of momentum going into the invasion. We also got some March data last week. Jobless claims for the survey week. That's the week that the employment report establishment survey takes place. It's the week that contains the 12th of the month. Those hit new lows. Continuing claims, which were for the week before, those are at their lowest level since the late 60s, when the labor market was half the current size. So again, the labor market momentum is very strong. And then we got the first 2 regional Fed surveys, manufacturing surveys for the month of March. The headlines went in opposite directions, but more importantly, both of those surveys showed prices received going up, so they had the ability to pass through higher prices. And the 6-month forward capital spending plans were very strong. That's a key part of our economic outlook, is that the mix shift is going to be favorable this year. We're going to have more investment, less consumption. That's going to drive capital deepening and productivity over time. That was apparent in those surveys. We're obviously going to get a lot more manufacturing data next week. The rest of the regional Fed manufacturing surveys, flash PMIs and all, and we still think the economy has very good momentum. So the Fed forecasts, as I said, look a little funky. Not expecting unemployment to rise as you fight inflation and tighten policy seems a little funky. We wouldn't get too carried away with the Fed's forecast. They just had the biggest forecast miss probably in the history of the Fed. So taking their forecasts too seriously is a mistake. But as we said, this was a big deal in terms of admitting that they're going to have to bring policy to a tight setting, and the balance sheet plan. As we said, Powell's had all but given us a commitment to start it in May. We did some really good detective work, and we have a very good idea on how fast we think that balance sheet contraction is going to be. We think it's generally going to be good news. I'm not going to provide all the details here. To dig into that, you really need to be a paid subscriber to our written research, where all the real details are. We give you lots of content on these podcasts and videos. We did some good work on that. We'll find out sooner rather than later, but for our subscribers, there's some good details in the notes on that. As we said, there's lots of concerns about curve flattening. Listen, there's a reason why the so-called recession curve is the 3-month bill 10-year note curve, not the 2-year 10-year curve, not the 5s bonds curve. Often the policy path implied by 2-year notes, which by the way haven't been around all that long anyway, is never achieved. That 3-month bill versus 10-year treasury, that curve is steepening. And it's at its steepest point in the last 6 years. So we're really not concerned about the Fed driving us into recession. And if you go back, as we did in a note, and you look at the history of recessions, the last time the Fed really drove us into a recession was the 80-81 combined Volcker recession. Before that, you could argue the Fed played a major role in the 58 recession, although there was also a pandemic, 60 recession, 69 recession. But recall, prior to the pandemic, which was one of the exogenous shock recessions, those we would identify as 46 and 48 related to World War II, and Truman's reelection in 48, the 53 recession with the end of the Korean War, the 73 OPEC embargo recession, and of course the 20 pandemic recession. The 3 prior to that were malinvestment recessions. That's arguably the Fed not dealing with a problem and allowing a malinvestment boom and bust. 1990 with the savings and loan crisis, 01 with the TMT bubble, and 08, of course, with the housing crisis. So we're not too worried about the Fed driving us off a cliff here and the curve starting to flatten. Term premiums are exceptionally low because of Fed purchases. The 5s, 10s curve flattening here is because the Fed announced they were going to start cutting back on their purchases sooner than anyone expected. Their average duration of purchases is 6 years. 5-year curve is more sensitive to that than the 10-year part of the curve. We had a really sharp move higher in 2s and 5-year real rates. The 2s, 10s real rate curve is actually quite steep. And that's what the Fed really has more control over. So we think that's a tempest in a teapot. We would not be worried about that in particular at all. And we would remind investors, we've written a lot about this, Fed corrections are 10 to 12%. We tend to get a full recovery in a slightly longer time period. So they take about 50 days to materialize on the downside, slightly longer for a full recovery. We tend then to be in a range for a quarter or two and then resume the bull market associated with the economic expansion. That we think will happen later this year after Labor Day, and we'll wind up with a decent year. So hang in there, buy weakness. And we were somewhat vindicated by last week's 6% move. But again, it's what we expected, and that's how the history has played out. So that's enough on the Fed. Again, there's a lot more details in the note. We'd urge you to consider becoming a full subscriber to our work. The Chinese did not regain credibility in our view last week. Chinese policy is very important with the direction of Chinese equities. And they do things like price keeping operations where they have their pension funds buy stocks to stabilize things. But their policy, Xi's doubling down on state control over the means of resources, is very negative for Chinese productivity. They have a huge debt overhang. The real estate market is not going to crash, in our view, the way it did in the US. But this is going to be a slow bleed that's going to be a major drag on Chinese productivity for many years to come. The crash of the real estate market in the US was a 10-year drag that caused disinflation and low productivity growth. It's going to be much worse in China. They're much better extending and pretending in the banking system. Here we took the losses that they didn't take in Europe, they don't take in China, and this problem is going to linger on for a very long period of time. We remain very negative Chinese equities. So on the energy patch, though, we remain very positive. And we referenced a op-ed from a former colleague of ours, Paul Tice, that was in the Journal, who described how deeply embedded into the regulatory system an aversion to developing fossil fuels really is. We don't think we're about to have another oil boom. We would remind investors that shale fundamentally changes the elasticity of supply. We think ultimately will make oil and gas companies in the US have much more stable return on invested capital. If you're developing conventional oil, drilling in the Gulf of Mexico, for example, could take 3 years. You plug that well, it's gone. All the CapEx is up front. In the case of shale, it's more of a manufacturing process. It takes 3 weeks to start a new well. You can shut it down, restart it. That should lead to much more stable return on invested capital. We really like the sector. They're generating cash flow. It's going to be much more stable. Return on equity is twice what it was back in 2015 and decades in the past. We've never had this big an overweight in energy, and we would continue to invest in energy stocks. It's going to take quite some time to restructure global energy supplies. The administration did approve 2 LNG export licenses last week. There's 4 more in the offing. The U.S. energy patch looks really good right here, and we would continue to be bullish energy stocks. So that's it for us this week. Barry Knapp, Ironside's Macro. Have a good week, everyone. If you're not a subscriber, we'd love you to consider becoming one. Lots of good details in all of our notes this week. As we said, there's some good stuff on balance sheet contraction and how fast we think it's going to go in the composition. Have a good week. Barry Knapp, Ironside's Macro. Thank you.